Cisco, stock ticker CSCO, released their earnings where they beat both on the top and the bottom line. As you can see here, $1.11 beat by 8 cents and revenue of $14.67 billion beats by 40 million. Not a massive beat on the revenue side, but a pretty decent beat on the EPS side, I would say. But more importantly, they also released their guidance for the full fiscal year, where they estimate revenue to be between $53.8 billion to $55 billion, which is a downgrade compared to the previous outlook. In response to that, the stock actually took quite a beating. As you can see here, Cisco is trading around $53. Post-market and pre-market, they are down to 47.25, minus 11.3% roughly. The performance over the last year is pretty good, up around 18%, and year-to-date up around 11%. And in other news, they also declared a 39-cent dividend in line with previous. If we compare to the S&P 500, you can see here year-to-date they are somewhat similar, a bit below the S&P 500, but still not too far off, I would say. Over the last year, a little bit better actually. Zooming out to 3 years, they are following quite nicely, roughly on the money, same amount. Zooming out to 5 years, those they are very far behind. They actually never really recovered after the COVID crash back in the start of 2020. Valuation-wise, it looks like a pretty decent time to actually buy Cisco if you're interested in the company. The PE non-GAAP forward ratio sits around 13 to 14, which is 7% roughly below the 5-year average, which sits at pretty decent around 15, roughly the median of the S&P 500 anyway. They offer pretty nice dividend stats. The dividend yield sits below 3%, roughly annual payout around 150. Payout ratio is not visible on this one, but we will get to that when we get to our stock screener. 5-year growth rate of around 4%, which is quite low to be honest, and dividend growth streak of 12 years. Looking at the history, you can see here they started back in 11, so as mentioned 12 years ago, and they actually had a pretty decent growth rate in the start, and then around 2019, then it started to slow down a little bit, so only increasing by 1 cent at a time. So I would be very surprised if the next increase wouldn't just be, you guessed it, 1 cent as well, up to 40 cents. We obviously also want to take a look at the financials. As mentioned in the start, you can see here the guidance was lowered a little bit to revenue between around the 54 billion mark. So if we jump into the financial statement, you can actually see here that revenue came in the last report back in July 23 around 57. So they actually expect a little bit of a decrease in revenue, and they say they had a pretty strong start of the fiscal year, and now people are actually spending a lot of time implementing the solutions they've sold, so the back orders are not that high at the moment. So the last quarter will probably be on the low side compared to the other quarters. But they still are growing their revenue, as you can see here back in July 2019, around $52 billion, now up to around perhaps around the 54 mark as mentioned in the guidance. Also obviously want to check out the net income. So scrolling down a little bit, we can find that. You can see 11.6 billion back in July 2019, up to 12.6 in the last report. The values in between is a bit of a mixed feeling. I think there has been a bit up and a bit down. So I don't think it's a huge increase they've had in the net income. But let's take a look at the cash flow statement to see what they are using that net income for. And scrolling down here to find the cash from operations, you can see here 15.8 back in July, now up to roughly just shy of 20 billion. So cash from operations are indeed growing quite a lot. And look at this one, the capital expenditures, not really that high at all. Actually, compared to 2019, they're actually a bit below. Obviously, back in July 2022, you can see here they were roughly half, but now it's still lower. So that means they are generating a lot of free cash flow, and that is exactly what we want. Coming down here to the bottom, you can actually see what the free cash flow per share is. $4.65. As mentioned earlier in the dividend stats, you can see the dividend per share was roughly $1.50. So there is plenty of free cash flow to cover the dividend. Roughly a third of the free cash flow per share is actually being paid out as dividends. So they are also retaining a lot of cash actually. But before we jump into the intrinsic value calculations, I do want to take a close look at Wall Street, what they think about it. And they have it rated as a buy, but pretty close to a hold. As you can see here on the analyst breakdown on the right, roughly 26 analysts has covered in the last 90 days. 8 of them has it as a strong buy. Maybe that will be updated now with the new earnings. I'm not sure how far behind this lags, to be honest, but one has it as a buy and a lot of them has it as a hold, where, as mentioned also here, that is pretty close to a hold. So I can understand why most of the analysts has it rated as a hold. Coming down to the price target, you can see the average price target sits at 59, just shy of $60, which means an 11% upside from the current levels. Again, I'm not sure if this is updated to take into account the latest earnings report, so this could be taken with a bit of grain of salt just for the start until this is updated, obviously. But let's jump into our stock screen and take a close look at Cisco Systems and all the key metrics and so on. As you can see here, the current price is still the $53 because this is being recorded before market open. So this will drop down whenever the market opens in a few hours. But as mentioned here, the PE ratio sits below the 5-year average, which could indicate a pretty good opportunity at the current time. They do have a lot of cash on hand and not a lot of debt. So net debt to EBITDA sits actually at a negative, which is extremely nice to see. I want it to be below the 3x ratio, so they are very, very much below that. Return on invested capital and return on equity are also looking really good. I think it's a very high amount and they are roughly in line with the 5-year averages. So it seems like management know what they're doing with the capital they have. I also think all the margins and ratios are looking pretty good. As you can see here, the operating margin growth over the last 5 years, yes, it is negative, but not a lot. So they have actually been able to retain a lot of the operating margin for the last 5 years. So they haven't been pressured on price, but obviously they haven't been able to expand it either, which is obviously something we want, but at least I don't want to see a massive negative number here. Let's jump into the dividend data tab and zooming in a little bit more. So what we want to see here is basically some steady increases. As you can see here, back in the early days, 45%, 20% increase and so on. I don't really want to see this. I want to see a steady growth instead. So you can see here the 5-year growth rate is around 4, which is very far away from, 20%, 24 and so on. So this for me is, I would probably expect it to grow very slowly in the future with these 2.7, 2.6%. The 10-year growth rate of 11%, I don't think that is sustainable for them to keep going with that, obviously. As you can see here, the last couple of years, they had just risen it with 1 cent per quarter. So I think they will continue to do that in the future. Scrolling down to the dividend yield theory graphs, you can see here we are roughly, I would say, based on these graphs, it's pretty fairly valued. As mentioned earlier, if you follow my other videos, whenever we get above into the blue area, it could indicate that the stock is undervalued. Whenever we go below the line in the red area, it could indicate that it is indeed overvalued. And over here on the left, we do have it spelled out as a percentage where there's nothing at the current time. So fairly valued, at least according to the dividend yield theory. But we have a lot of other valuation methods, such as the discount cash flow model and so on. So zooming out a little bit so you can see all of my estimations. As you can see here, the free cash flow was extremely high back in last year. So I am not sure if this can be followed up every year now that also the guidance for the fiscal year is lowered. So this remains to be seen, but I will obviously follow this quite closely. But other than that, you can follow all my estimations here. For example, also for the dividend discount model, the multiples valuation, I think in this case, the median PE, which it takes here, is extremely high compared to EPS. The EPS is also based on the guidance from the management and not the actual EPS. So that is why I use this one. So this indicates a very, very high stock price. As mentioned, the median PE is for Cisco is roughly half here. So it sits around 55 actually would be the correct stock price here. But as mentioned, compared to some of the multiples or other companies or peers and so on, the multiple that they are using is very, very high. So this is obviously if we have to compare them to those companies. Also, Graham's revised valuation method, you can see here I've overridden the EPS using the guidance, which gives it an intrinsic value of 51. Then we also have the PE model, free cash flow variation, and then lastly, the Peter Lynch model. Before we jump into the summary, thank you so much for watching. If you haven't done so already, please consider subscribing to the channel for more videos in the future. Now let's jump into the summary and then zoom in a little bit more just to see everything a little bit better. I did exclude the multiples mainly because, as mentioned earlier, the price was so widely out of line compared to the usual PE ratio. I highly doubt that Cisco will ever go to 25 or 30 multiple compared to the 13 to 14 or 15 they are around now. So obviously, as you can see here, if we include it, you can see $110, which is, I just don't think it's possible for the stock to ever get to that amount currently. So I think will exclude that one. So what remain is the remaining methods here, and that averages up to $52.72. With the current price being $53, which is 47 by market open, the average discount actually looks pretty good. We also want to incorporate a margin of safety, obviously, which we have over here on the right in our margin of safety calculator. We start with a standard of 25, and then based on some of the key metrics that we showed earlier, such as the key metrics over here and so on, we then arrive at a margin of safety based on some of these key metrics where we either add or deduct a little bit of margin of safety. In this case, we end up with 5. So these 5% of margin of safety we can transfer over here, put in here, and then we get an acceptable buy price of $50. With the current price being 47, it could actually indicate a pretty decent buy to if you want to go into Cisco at the current level and get that roughly 3% yield, which will go up a little bit now that the stock price plunges a few dollars. So as you can see here, I think they'll make it a pretty nice yield compared to that one. And also if we just go in here again, you can actually see that it has been hitting some pretty high amounts, such as not long ago, a few months ago. I think it can go back up there. A few, even more months ago, around May, it actually was down 47, so we're not too far off of that. So I think definitely it has the potential to go back up again, and maybe it will pick up after the next quarter. I think it will be probably a very good idea to start to dollar cost average into Cisco if you're interested in the company, because I think it's a very attractive price. And whenever the orders start to come in again, I think the price will start to go up again. Obviously, do your own due diligence, but for me personally, I would definitely look closer at Cisco after that drop. Thank you so much for watching, and I'll be seeing you in the next video.